Your passion for Roth IRAs is truly kind of inspiring.
Welcome to the Mach 1 Market Moment, where we provide financial information on topics such as investing, insurance, financial planning, and everything related to your money. A quick reminder that the hosts of the show are employees of Mach 1 Financial Group. This podcast is for informational purposes only, and nothing said in the show should be taken as investment advice. Employees and clients of Mach 1 Financial Group may maintain positions in the securities or strategies discussed. We upload a brand new podcast every Thursday, so be sure to subscribe to our show so you never miss an episode. Also, follow us on all of our social media platforms. We are Mach 1 Financial Group on Twitter, Facebook, LinkedIn, and YouTube.
Matt and Matt, we're here for episode number 65, and today we're talking everything about Roth IRA conversions. Conversions, that's a very important word today, right? Matt Walters, and we also have Matt Hager here, our marketing director and our producer today. Well, I should give Erica kudos because she's doing some of the producing. Okay, so Matt, we're talking about Roth. We've got Roth contributions and we got Roth conversions. Today's podcast is going to be about conversions, but explain to our listeners the difference between a contribution and a conversion.
Yeah, so we've talked about Roth conversions and contributions several times, I feel like, over the last year, but it's been a hot topic. I mean, with potential tax legislation changes and, new administration taking over, it's been on kind of everybody's mind. So the difference between contribution and contributions are direct contributions from your earned income in a specific calendar year. So like, if you made $100,000 this year and you want to put up to the limit, either $6,000 or $7,000, depending on your age, into a Roth IRA, as long as you have earned income and you don't make too much money, then you can put a contribution directly into that account. A conversion is when you already have funds in an IRA or 401k or tax deferred account that you want to go ahead and pay the taxes on and move those funds into a Roth IRA. That is a conversion. So there's different limits, different amounts, income, all that to both scenarios.
And the whole point of a Roth IRA is you pay the tax now, and you never, ever, ever, ever pay the tax again, including your heirs. Whereas an IRA, you tax defer until you pull it out, and you just don't know how much the tax is going to be because you don't know what the tax rate will be when you pull it out. So a lot of good reasons to be thinking about Roth IRAs and Roth conversions right now. All right, so that's what a Roth conversion is. So Matt, you kind of hit on it about what types of accounts you can actually convert to a Roth IRA. So what are some typical accounts that we would see here in our office?
Well, I mean, the most common would just be a traditional IRA. If somebody has a traditional IRA that they have funds in, that would be what you could convert from. There are other types of accounts. You can have different types of IRAs, but an IRA in general, regardless of the specific type of IRA it is, as long as it's tax deferred, then those are funds. Those are funds that you could pull from, convert over into the Roth.
And it doesn't matter how much it is. The government is happy for you to pay all the tax right now. So it doesn't matter if your IRA is large or small. There's no $6,000 or $7,000 limit. The limit is, do you have the cash to pay the tax?
Right.
We'll cover that in just a second here. Okay, so who's eligible? Can I do a Roth conversion? Can you do a Roth conversion? Can Matt Hager do a Roth conversion?
Yeah, there really are no eligibility requirements for Roth conversions.
So earned income, not an issue.
No.
Doesn't matter if you have earned income or not. You can be retired and do it. You can be working and do it.
It actually could be better if you don't have any earned income.
Why is that, Matt?
Well, because the conversion, we can convert more, most likely in a lower bracket, if we're not adding that on top of our other income, earned income, or whatever it may be.
So that's a good point. So any money you have in an IRA, 401k, tax-deferred account that you convert to a Roth on your income tax at the end of the year, it looks strangely like income.
Yeah, well, it'll look exactly like it from a tax standpoint.
Even though you didn't bring it home, you convert it to a Roth IRA. On your taxes, it'll look like you just got that amount of money as income. So you're going to pay taxes on it. So like Matt said, you want to make sure you don't do too much because you could bump you in a higher tax bracket, which you may not be later on. So you got to do some analysis on this to be what the sweet spot is to how much to convert.
Absolutely. Yeah, definitely want to crunch numbers. One of the best times for people can be, every situation is different, but are those first few years of retirement. So if you retire and all of your earned income goes away, and let's say we have some non-qualified funds or resources that we plan on living on those first few years of retirement. From an income standpoint, you may be in like a 0% tax bracket very well. If you're pulling from non-qualified funds or cash that you have at the bank or wherever it may be, those first few years of retirement, well, that could be an excellent time to do some bigger Roth conversions and try to get that money moved over before then maybe Social Security kicks in or you're starting to take money from your IRAs or 401k. So there's definitely some strategy about when you do it, how much you do it, and all those types of things.
That'd be a great strategy too, because you got that huge standard deduction too that would offset some of the taxes.
Right.
And we're working with clients right now. We're thinking about using some donor advised funds to help offset some taxes. So there's a lot of things you can do to help minimize your tax liability. And speaking of taxes, Matt, where would be the best place to pull money to pay taxes on a Roth conversion?
I mean, the best place is to pay for it out of pocket. So to pay the taxes out of pocket. So cash you have at the bank, non-qualified investment funds, something that's not in an IRA or Roth. Because when you're converting, if you're over 59.5, you can withhold the taxes from the conversion. The downside to that is the net amount that gets deposited into the Roth IRA account is then less because it's minus whatever you had withheld for taxes. So the more we can get into the Roth, the better. If you're pre-59.5 and you're doing a conversion, then you definitely want to pay the taxes because out of pocket or with cash, because any taxable amount that if you try to have the taxes withheld, that's going to be looked at as an early distribution. So the amount that's withheld for taxes that doesn't get moved over to the Roth is going to have an additional 10% penalty. So there's one more reason you'd want to try to pay the tax portion out of pocket.
So let's put some numbers on that. So if we want to do a $100,000 conversion, and if I have, let's say our tax bracket is 25%, make the math easy for us. So that'd be $25,000 in taxes. So I can either put $100,000 from my IRA into the Roth and reach over here in some other account and pay the $25,000 in tax. Or I can take my $100,000 IRA, turn it into a $75,000 Roth, and pay $25,000 in taxes.
Right.
Now that's if I'm over 59.5. If I'm under 59.5 and I put 75 in and take 25 to pay the tax, I owe another 10% penalty on that 25,000.
Right.
So your point's right. If you the best place to do is if you have after-tax funds to pay the tax. Not everybody can do that, but you just need to know all the parameters that go along with that. Matt, we talked earlier before we started recording about some things you ought to think about too. Let's say you are 64, 65 in that area where you're already planning to take Medicare. What does Roth conversions do to your Medicare payments?
Well, they can increase your Medicare payments. So they can really kind of jack up your Medicare payments. And you were mentioning with IRMA, it goes back, it has like a 2-year look back. So even if you did Roth conversions at 63 and it bumped up your tax bracket and increased your taxes and all those things, well, that can have an effect 2 years from now when you go to qualify for Medicare and apply for that.
So the moral of that story is before you go out and rush out and do a Roth conversions, and we think they're wonderful, by the way, but you need to make sure you have a plan. How much, when do you want to pay the tax? Know all of those things before you rush out and do it. And we can do that here at Mach 1, right, Matt?
Yeah, absolutely. We can help you crunch the numbers and do all that analysis for you. One thing to keep in mind, and I think this is a common misconception, is why would I want to take my $100,000 account and make it a $75,000 account in the example that you just gave? So why would I want to, if I had the taxes withheld, move that over? Because I had $100,000, now I've only got $75,000, so I have less money, right? You have to always look at everything from on an after-tax basis. So what is the net amount to you after taxes? And in both scenarios, whether you have $100,000 in a traditional IRA or a $75,000 in a Roth, assuming you're in a 25% bracket, they're identical, right? So there's a lot of education that's been out there for a long time about where you should put money and how you should let it grow and whether it should be tax deferred or not. But what you ultimately have to keep in mind in the Roth versus traditional, or Roth 401k versus traditional 401k, is it's a tax question. Are you going to be in a higher tax bracket or lower tax bracket when you're putting the money in versus when you're taking it out? And that's all it boils down to.
That's a great question. If our listeners are sitting out there right now, if you say, in the future, are my taxes going to be the same? Are they going to be lower? Or are they going to be higher? That'll help you make the decision whether you need to do anything with a Roth or not. If you think they're going to be higher than they are today, you seem like a good candidate to have at least a discussion about a Roth conversion. So how would somebody convert an IRA or 401k to a Roth? How do they do that?
Well, the easiest way, like clients, with us, we custody at TD Ameritrade. So let's say someone has an IRA at TD and a Roth IRA at TD, then it's just submitting some paperwork to TD Ameritrade and asking them to transfer the funds over. And on that form, you're making the determination of whether you want taxes withheld or how much or whatever the situation may be. So assuming the accounts are already open, it can and kind of should be a pretty straightforward process. Now, if you need to go out and open accounts, you're obviously going to have to walk through that, but it's not difficult. The difficult part is figuring out should you and when and how much.
That is the key. And if someone has a 401k and they say, you know what, I might want to do that now, well, there are some different rules about getting money out of a 401k. And if your 401k has a Roth IRA portion, you could actually do that there. But again, like Matt said, should you, if you should, how much and when? And we can help you with all of those questions. Okay, Matt. So we got money now into a Roth IRA. What are the rules about pulling it out?
So this is, me and you were talking before we got on here, Mike. There's this kind of been a big gray area for a long time in the tax code. Just a lot of misunderstood code here. I think even I've talked to a lot of CPAs and I've got conflicting advice. But ultimately what it boils down to is for most situations, there's a 5-year rule in terms of how long you need to have the account open and or funded. So a couple different things here. I'll try to explain this clearly. So let's say you're doing Roth conversion, since that's our primary topic for today. Every time you do a conversion, there's a 5-year rule or 5-year period that you need to wait before you start to take those funds out. So if you have a strategy to convert over the next 3 or 4 years, so maybe we're going to convert $20,000 per year over the next few years. Each one of those $20,000 conversions are going to have a separate 5-year look back or rule, period that you have to leave the funds in there before you can withdraw.
So Matt, just to make clear, so we got a 65-year-old and they want to do what you just said, $20,000 a year. So they need to be prepared to leave that money alone for that 5-year period for each conversion, and each conversion stands on its own. Now we're talking conversions now. Okay, so now we got conversion. Every conversion has its own 5-year waiting period.
And when you think about, anytime you're doing a conversion, that shouldn't be an issue because that should be a longer term strategy, right? The goal of that should be to get the funds into the Roth and then let those funds grow for, ideally as long as possible before you need to really start taking them out. So there's no point in doing a Roth conversion and then taking the funds out the next year. You might as well just take the distribution from your IRA. It's going to be the same from a tax perspective. So hopefully not an issue, but definitely something you want to be aware of. I think it's probably something a lot of people aren't aware of.
And just to add to this, now contributions are a little bit different.
Right.
Any money you put in a contribution, you can take out right away. You can take contributions out anytime. The growth, however, has a 5-year rule on it, and it also has a 59.5 age limit on it, correct?
Correct.
All right, so contributions, conversions. We're mainly talking about conversions today. Here's a good question for you, Matt. So I'll soon be 62. I do some conversions, and now let's say I'm 68, and I pass away. What happens?
Well, the funds stay in the Roth and are left tax-free to your heirs.
Tax-free to my heirs. Doesn't matter what the tax rates are. And now they have up to, if I leave it to one of my children, they have up to how long to take it out of the Roth?
10 years.
So at the end of 10 years, they just can't leave it inside the Roth and continue growing tax-free the rest of their life. They get to take it out tax-free and do whatever they want. They can put it into a Roth at their time, whatever the contribution limit is for them. But it can grow tax-free as long as I have it, and at least 10 more years for them tax-free. That's awesome. Okay. All right. So, okay, Matt, so let's say we have a client and we've done a Roth conversion and then the taxes go down. I know that doesn't sound like it's feasible, but let's say it did. And they paid tax this year at 25%, and next year they're in the 12% bracket. Can they undo the Roth conversion?
No.
No. Under the CARES Act last year, I believe that's correct, that changed. Once you do a Roth conversion, you're locked in. You're locked into it. You cannot undo it. Used to, you could recharacterize it, but you can no longer do that. Okay. Whew. Wow, a lot of stuff about Roth conversions today. All right, again, we're talking conversions, folks. The government lets you convert all you want as long as you pay the tax, and they're happy for you to pay that tax bill. So be careful before you start thinking about this. If you think your taxes are going to be higher in the future, you should give us a call here at Mach 1, and let's go through your situation just to make sure that you've considered all the elements that it will impact, like your Medicare, like your tax brackets, when you need to take the money out, among a few. All right. Matt, is there anything else we should know about the Roth conversion today?
I think we covered it.
All right. Well, good. Matt's a wealth of knowledge here. Come here to Mach 1. Give us a call. We'll talk to you about your Roth IRA contributions or your Roth conversions. Erica, can you tell folks how they can submit a question?
Yes, you can submit any questions that you have to the podcast section on our website or email us at podcast@mach-1financial.com.
All right, folks, so that's it for today. We appreciate you listening to the Mach 1 Market Moment. We'd like to end each podcast with a Thaw of the day. This one is from someone we all know. I love the Roth IRA. Tax-free income in retirement is a truly great deal. That's it for today, folks. Thanks for listening to us here at the Mach 1 Market Moment. We look forward to you joining us next time on the podcast.
Mach 1 Financial Group, Inc., Mach 1, is an SEC-registered investment advisor located in Bentonville, Arkansas. Mach 1 may only transact business in those states in which it maintains a notice filing or qualifies for an exemption or exclusion from registration requirements. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular skill level or ability. Past performance is not a guarantee of future results. All investment strategies have the potential for profit or loss. The information presented is the sole opinion of the speaker and is not meant to be investment advice. Mach 1 does not provide tax or legal advice. You should speak with your tax or legal advisor regarding your specific situation. For full disclosures, please visit www.mach-1financial.com/disclosures.